So we have with us today Mark Mahaney, Senior Managing Director at Evercore ISI. Mark, let's dig into Netflix together. The company beat expectations across the board, especially on its subscriber numbers. But if you look at what's happened with the stock's reaction, you wouldn't guess it. So what's going on right now? Why the response we're seeing?
I think there are three reasons. One is, just keep in mind the stock was up 25% year to date going into the print. That means expectations were high. They did what I would call a beat and bracket quarter, but you needed to do a beat and raise quarter, like clear emphatically have estimates go up. So that wasn't there. Second is when they gave their full year revenue guidance of 13 to 15%, so that's new guidance. The street was at the high end of that, but what that implies, given their outlook for the first half of the year, is pretty material deceleration in the back half of the year. So stocks that are trading at 30 times earnings when they guide to material deceleration, that's not a good combination. And then the third is, and what people have harped on a lot today, is the reduced level of guidance. They've said that starting in the March quarter of next year, they'll stop disclosing the actual number of paid subscribers. They'll give you some offsets. They'll give you full year revenue guidance consistently going forwards. That'll be new for Netflix. But the less disclosure on what has always been viewed as a really key metric irks a lot of investors, and for good reasons. And that's the third reason why the stock's trading off.
And Mark, just to sort of tie into the point you made at the beginning, which is the implication is growth deceleration with numbers of subscribers in the back half of this year. Do you think that was a part of the decision to back away from providing subscriber numbers going forward? Or do you think engagement really is the metric we should be focusing on right now?
I think you need to focus on subs and engagement.
Yeah.
So I think it's a mistake on their part, but maybe it's not a huge surprise. They've been reducing their disclosure about subs now for a while. They used to give detailed sub guidance for the following quarter. They stopped doing that about a year ago, and they've been saying for a while they really want to be judged on revenue, operating profit, and free cash flow, and which are the right metrics really to focus on. But subs have always been a key part of the story. They always will be. And I'm sure everybody's going to continue thinking about the company in terms of subs. They said they'll give milestones, I guess. I don't know what that
Mm.
means, every 10 million or every 20 million. But people are still going to make their assumptions about subs. I think it's better that they disclose it rather than people guess it, but that's their call.
But and based on where we are today in the terms of their total number of subs, Mark, do you think that they've actually peaked in terms of developed market penetration, or do you think that there's more room to run?
My strong guess is that there's a lot more room to run, and for three reasons at least. First is, they lowered the price point. When we did surveys over the years, we started seeing rising price sensitivity beginning in 2018, and it was the number one reason why people churned, why they wouldn't churn back, why they wouldn't sign up, and yeah, so price there was material price sensitivity here. And then, a year and a half ago, they implemented a 30% price cut. They took the world's best streaming service and they lowered it by 30%, like to $6.99, and the equivalent in international markets. So I thought by doing that, they materially expanded their TAM, or total addressable market. Secondly, there is this paid sharing crackdown, and I don't know, there were 100 million or maybe 125 million borrowing households around the world, people who use other people's Netflix accounts. I've got a few people who use mine. They're called my sons, and they Netflix wants to try to monetize those a little bit better. I think they're going to be able to do it. And the third thing is the reason why, like, this is a hit factory, and people tune into Netflix because there's more content and there's better content, and it's a library that keeps growing. And so, especially as they do things like they expand into things like worldwide wrestling content starting next year, as they get more gaming, and then just the library gets bigger and bigger and gets more international. I don't think there's any way that I think they have 270 million paying subscribers now. I think that number goes to 500 million over time. If you get 3 billion smartphones in the world, I don't know why a third of them wouldn't somehow access Netflix.
The other content machine and the hit maker, Mark, that we talk about a lot is Disney, and that has replenished itself and its libraries over time through acquisitions such as Pixar and Lucasfilm and Marvel. Do you see Netflix going down the M&A path at any point?
Not in any big way, not like traditional media companies have. They have done so few acquisitions. I mean, I think it's like two or three, and they've been very small. So it's a little bit of that not invented here mentality. I don't know if that's good or bad, but that's been their mentality. And Yeah, with their uses of cash, I think, and they have also a very unusual culture at Netflix. I think that's true. It's a company that doesn't have a vacation policy, for example. That's just one example, but it says something about the broader culture of the company. So I think the idea that they would buy, I think it's unlikely they would do another major material M&A deal.
Let's talk a little bit too about the ad-supported tier, Mark, and the advertising revenue potential that sits at the business. What are your thoughts on where that ad model goes from here for Netflix?
They really kind of went into it reluctantly, as you know well. They said for years we'll never do ads, we'll never do ads, we'll never do ads. Well, they did ads, and I think it happened because they kind of a little bit went ex growth on their paid subscription business. They needed to do something. Well, they pulled out these two really interesting and successful product cycles: the ad supported business and paid sharing. Now, paid sharing everybody's focused on for the last year or two for good reasons. I think people have underappreciated what's happening under the surface, which is, it's about 40% of their new ads coming in are ad supported, are coming in on the cheaper plan, and I think that speaks to, maybe those people would have come in anyway. I don't think so. I think there's a significant amount of those that were truly incremental that wouldn't have signed up for Netflix except that it had the lower price plan. So I think it's next year where you're going to finally get ad revenue to be sort of material, like close to 10% of revenue. I think it's still low single digits. I mean, 40% of your new subscribers coming in on the ad plan sounds great, but you're talking about they're adding. I'm making these numbers up. If you add 30 million subscribers this year, and say half of them, 15 million, are ad supported, that's on a base of almost 300 million. So it takes a long time to really move that needle, but that needle will be moved. I think by the end of next year, ad revenue will get to that, kind of chunky 5 billion level or something like that. And then, yeah, when they get big enough, when they get enough ad viewers, that's when they'll become a must buy for ad agencies, marketers. They're not there yet.
Do you think their foray into sports accelerates their path to becoming a desirable and must-have destination for advertisers? As we've seen, as you
Yes.
mentioned, wrestling. We've got Jake Paul versus Mike Tyson fight coming up. Sports seems to be one of the few bastions left for having consistent advertising dollars coming after it. Talk to us about what Netflix is doing in sports and how ad revenue may accelerate as a result of it.
Well, I think what's implied in your question is accurate. It's likely to lead to uh, more. Netflix is going to have more viewers of sports, sports entertainment, some live sports. I mean, its reach is bigger than ESPN's. It's they've got half a billion people. If you're They got about half a billion people all in who use Netflix, and off of 270 million paying accounts, is usually two people per account, something like that. And so you got half a billion people. That's a big sports funnel, big sports audience funnel. And so, yeah, I think the same thing is going to happen with sports as happened with ads, frankly. And years and years, no ads, and then they turned on ads. Years and years, no sports. They kept their favorite lines were, "We're not anti-sports, we're pro-profit," or "Sports has been a lost leader. Live sports has been a lost leader for linear TV for decades, and we don't need a lost leader." I've heard all that, but you just see them around the edge doing that Alcatraz tennis match, the Tyson fight. They're just doing a little of these things right around they're dancing around the live sports stage. Not that they're going to do some major license, but there's so many ways for them to monetize sports, and especially sports entertainment. So I think you'll see them do more, and I think the result will be more subs, more engagement, and more ad dollars. I think it's almost inevitable.
Mark Mahaney, Senior Managing Director at Evercore ISI. Come back, talk to us more about where those ad dollars are coming as we progress through earnings season. It's great to chat to you as always.
Good to see you, Ann.